Let's get to Steve Leisman. He is live from the Boston Federal Reserve with a first on CNBC interview. That's the Boston Fed President, Eric Rosengren. Steve?
Scott, thanks very much. Yeah, we are inside the Boston Fed here with Eric Rosengren. President Rosengren, thanks for joining us.
Nice to be here with you.
Job growth this morning coming out below expectations. The street looking for 145, came in 136,000. But the unemployment rate falling to 3.5%, a 50-year low. Give us your initial reaction to this jobs data this morning.
So as you highlight, the unemployment rate is quite low at 3.5%. Over the course of the summer, it was at 3.7. So the household survey was a little bit stronger than the payroll survey. I think you have to keep in mind exactly where we are in the cycle. So we have a very low unemployment rate at this point. We're relatively close to 2% inflation. So the kind of job growth that you would expect if you're trying to keep the unemployment rate basically constant and the inflation rate constant would be in the range of 90 to maybe 115,000. So we're getting to the point where we're getting about the kind of employment growth that I would expect in kind of a stable economy. I think the bigger question is whether it ends up being weaker from here, and that depends importantly on what happens on the consumer side of the economy.
When you look at the level of job growth, do you want to bring it down? Do you want it to be lower? Do you want the unemployment rate to be stable or higher? Why can't we go lower on the unemployment rate?
So there are a couple reasons why we get concerned if so the committee as a whole thinks that the median estimate for where unemployment rate would be over the longer term would be 4.2%. So 4.2, 3.5, we're already pretty tight.
But let's be clear about
this. And the reason for that is twofold. One is in periods where the labor markets are quite tight, we expect over time that wages and prices will go up. So core PCE has gone up from 1.5, 1.6 to 1.8. Core CPI has gone from 2 to 2.4, so we have seen some movement in prices. We also have to worry about financial stability. So you press the economy too hard, and you start finding different pockets of the economy starting to have more troubles than you expected.
I was just going to interrupt before as a kind of informational note here that the committee has had a differing view on this, what the right level of unemployment is. It used to be above 6%, and we're learning now, aren't we, that we can operate this economy at a lower unemployment rate without inflation?
It's definitely true that the estimate of what the unemployment rate would be in the long run has come down. That does move around for a variety of things, and it includes kind of what the demographics of the population are. So different age in the population does make a difference. The amount of immigration makes a difference. Population growth in general makes a difference. Education makes a difference. So all these factors are things that go into thinking about how tight can the labor market be before we start seeing wage and price pressures.
Let's talk about the broader macroeconomy. When you look at a number like this, you look at where the job market is. But we've had two key indicators this week, the ISM service indicator and manufacturing, both weaken from where they were certainly last year. What's your overall outlook for economic growth?
So my overall view is it's going to be around potential for the second half of this year, so the third and fourth quarter. My estimate of potential is around 1.7. That's pretty consistent with what the private sector expects for the last 2 quarters of this year. I think that data that we have is weaker than it was before, but is actually pretty consistent with getting around a 1.7. If we start getting much slower than that, then that implies a rising unemployment rate, and then we would really want to think about what's happening in the economy. I would say that some of the data that we've gotten over this week's not a complete surprise. So we know that tariffs are having an effect on the economy. We know that the manufacturing sector globally is being impacted by what's happening with trade. So we would expect that exports and manufacturing would be weak, and that's exactly what we're seeing. The bigger question, I think, is does it spill over to areas not directly affected by trade concerns? And that would be, is the consumer still confident enough that they're going out and spending? Up to now, we've had pretty good consumption. Wealth is still pretty good. Personal income's pretty good. So there are a lot of factors that you would normally think would be dominant for the consumer that actually still are indicating that we should see pretty strong consumption. But there's always the concern that some of the concerns that are occurring from trade, from some of the headlines that you just referenced, might start causing consumer confidence to ebb. And if that really does occur, then we have to think about whether the economy would slow down from here.
People talk about the Fed and the trade war in the following way, that the Fed needs to deal with the effects of it, but shouldn't enable it. Is that your idea?
So we have to, We have a mandate. The mandate's tied to inflation and unemployment. So if we don't think we're going to get maximum employment, or if we think we're going to miss our inflation target by a lot, then we should do something differently, regardless of what the source is. So we don't control fiscal policy. We don't control what's happening globally. We should react to those things and try to make sure that, as best we can, we keep the labor market and inflation on an even keel.
We talked about the job market. We talked about the trade war. What's your outlook for policy in context of all these things? The market seems primed right now for a rate cut. We came in before this interview. It was running at about an 80 or 85% probability of a rate cut this month. Do you think that's the right course?
I still have an open mind. We still have more data between now and when the meeting actually occurs. I'm going to be quite attentive to what's happening with anything that indicates that the consumer is changing their view. We had an auto report that was reasonably strong. So if we were really worried about the consumer getting very concerned, you wouldn't have thought auto sales would be quite as strong as what we saw. So we'll have to see how the consumer is continuing to react. We'll have to see what's happening on the price side as well. So I think there's still a little bit more data before the meeting. I don't think I should prejudge it at this point. We've already had 2 easings. The easings don't have their impact immediately. Monetary policy currently is accommodative. So in the longer run, we think that a Fed funds rate around 2.5% would be the appropriate long-run federal funds rate. We're now below 2%, and Fed funds has been trading around 1.9. That's quite a bit below where we think the Fed funds rate should be in the long run. So I think we need to monitor the economy, see if it looks like we're on a stable course or whether it'll be weaker than that.
You've been a lone voice when it comes to the concerns about financial risk, when it comes to the rates being too low. What are those concerns? Do you see reasons to be concerned right now about the level of financial risk created by low interest rates and this reach for yield and the moving up the spectrum of risk by investors?
So I do worry about the incentives that are created when you have low interest rates. Low interest rates in a recession doesn't cause a lot of financial stability concerns because both households and firms are pulling back. And so you don't have a lot of risk taking. In fact, monetary policy is trying to encourage more risk taking at that time. When you have an unemployment rate at 3.5%, when you have a stock price that's still very high, then that's a situation where I don't necessarily want to encourage households or firms to take on a lot more risk. The household sector doesn't look all that risky right now, but I would say that the firm side does. That leverage is quite high at a wide variety of firms and industries, and corporation debt is quite high relative to what we've seen historically.
You talked about this issue of co-worker space, which is WeWork, the biggest player in that space. They seem to have pulled back from an IPO. Are you a little more encouraged from, actually, since you made that speech and what's been happening, are you still concerned about what's happening in that industry?
So I gave a speech at NYU that talked about the financial stability risks from this co-working space. And it's really the idea that you have long-term leases, but you're providing short-term leases to individuals or small companies that whenever we do have an economic downturn, might be some of the first people to be unemployed. And in that kind of situation, we should worry about whether that space would become more vacant quickly or more quickly than we've seen in the past. So I think we do need to think about the model itself. It's not necessarily specific to an individual company, but really thinking broadly about what is the incentive of a landlord to provide a longer-term lease to somebody who frequently has a bankruptcy remote structure so that they can walk away from that lease. What are the times that will occur, and what does that mean for the economy overall?
Eric, just a quick thing here. The conference you're having right now is looking at something the Fed has to deal with. You have one tool, but one country with many different places that are have different economic levels of activity and changes. How do you deal with that? You have to change rates up or down for the whole country, and yet what you're studying here shows that, for example, urban centers are having a very different outcome from rural places.
So that's exactly what we are studying. Is the experience in Boston, for example, is somewhat of a super city. We have a lot of young people. They tend to be highly educated. Their incomes are growing quickly. But you get to rural New England, you get a very different experience in upstate parts of Maine or Vermont. And as a result, we're seeing big disparities in outcomes. Monetary policy itself is not a particularly good tool, but I think we do have to think about other ways that we make sure that we don't just think about the economy overall, but we make sure that some of these geographic disparities over time get reduced. So traditionally, economists thought we'd focus on individuals and job training and that people would move to where the jobs are. Increasingly, we're seeing we need to think about how to get the jobs to the people because the people don't move as much as we would think.
Eric Rosengren, president of the Boston Fed, thanks for joining us.
Thank you.